Now joining us in studio, Tom White is here to help kick off the day and, of course, talk through this top story that we're dealing with here with the CME halting these futures. You know, Tom, I think we both showed up on this Black Friday morning thinking it would be a quiet day post-holiday, and instead we have no trading action, no futures or options to discuss. You know, walk us through what's happening here and what's the latest.
Yeah, it's quiet because nothing's going on. Actually, some of the metals are starting to trade a little bit. They're going to start to roll out a little bit of it. But at the same time, when you look at something like this, where it's typically a quiet day anyway, I don't think anybody's real concerned the fact that we're not seeing any action in the futures. But I think you made a couple good points. All the volatility, all the consternation that we had in equity markets over the past 3-4 weeks has kind of gone by the wayside. We got the VIX basically at 1 month lows, so volatility is pared back. We've got a big, massive run-up in 4-day win streak here for equities. The Russell 2000 is actually positive in the month of September. And then you look at the S&P 500, we're only down 0.4% from Wednesday's close as far as the month. So this little resurgence that we've seen, is that the kickoff to a Santa Claus rally? Well, maybe. You've got yields, which are continue to fall. Rate expectations for a rate cut in December are now up to 86%, according to the CME FedWatch tool. So that's lending some support to equities. And then maybe a little bit of the friction that we saw with the AI trade, the potential bubble. We're still seeing some stocks that are taking it on the chin. But I think what's really healthy for equity markets at this point is that they're not rotating out of the markets. What they're doing is rotating into maybe beaten down sectors. We saw healthcare hitting all-time highs, the S&P 500 sector in the healthcare. That's starting to rebound a little bit, led by gains in Merck and Eli Lilly hitting record highs yesterday. So I think that's really healthy for equity markets when you're seeing rotation into other sectors that maybe had underperformed, as opposed to everybody selling AI. Now let's get out of everything, which it seemed like that was happening at the start of the month.
Yeah, certainly did, you know, and you bring up some good points about this rotation and especially with the Santa rally coming into the end of the year. And a lot of the conversation with this tech sell-off has pivoted to retail and what we're learning about the consumer and the spending coming into the holiday season and some of those incredibly strong retail earnings that we've gotten in the last week. And we've got more retail earnings next week with Macy's coming, a Dollar Tree, Dollar General, some of the lower budget ones. You know, as far as expectations of how much that is going to bolster the markets going forward through the end of the year, you know, the spending estimates are supposed to be strong, and I imagine we'll be talking about it a bit in the show today, too, in terms of today being Black Friday. But as far as how much you think pull will get on that?
Well, I think, you know, it's really weird. There's a bifurcation going on in the markets because you see consumer sentiment, consumer confidence numbers just keep on waning. But then again, at the same time, you've got expectations for GDP growth. The Atlanta Fed GDP now 4% right now for the current quarter. So we've seen that bifurcation where, hey, this rally that we've seen so far in 2025 has been one of the most hated rallies, right? But then you've got, hey, inflation, we've got tariff impacts, we've got government shutdown impacts, but it seems like the consumer, which is led by, you know, the more affluent consumer, they're not taking it on the chin as much as maybe the lower end consumer. But the earnings that we've seen has kind of led to what we've seen in the overall equity market, that, hey, earnings have been a lot better than we had anticipated at this point. So some of those headwinds, which are tariffs, government shutdowns, consumer confidence, sentiment data, really doesn't matter. It gets thrown out when you've got hard data that is reflective of a strong consumer at this point. Now, consumer spending is supposed to be up to $1 trillion, I believe, this holiday shopping season, which is above expectations and estimates that we saw from last year. But at the same time, you're seeing a lot of analysts come out and say, hey, there's going to be a little bit of a pullback. It's going to be maybe that consumer that's picking and choosing, but still out there purchasing at this point. So if we do get some, good preliminary data, maybe from Adobe Analytics and stuff like that, that might lend some more support to that. But if you look in the retail space, we've seen some real winners and losers. I mean, who would have ever expected that Kohl's jumped 40% post-earnings? I mean, That being said, I've never been into Kohl's, so at the same time, there's other retailers that aren't doing well, but we've got some discount retailers, Dollar General, Dollar Tree this week. We'll get some more clarification on that, but watch names like Costco, which has been in a downtrend. I mean, Costco hasn't been in a downtrend for 5 years, since before the pandemic. So that's really an interesting one. And then how Walmart will do. Everybody's going to be watching that one too.
Of course, our retail bellwether. Now, speaking of downturns, I want to talk about Oracle, because in the last month, prior to trading being halted, down about 27%. But we've got some big news on Oracle here. Another, potentially their largest debt package that they've taken out to help fund these OpenAI constructions. Yeah,
so this comes after that $18 billion project loan that they had for their New Mexico data center. And this isn't good, I think, for Oracle, because their borrowing rates and some of their loan obligations are starting to rise to levels that we haven't seen since the financial crisis, and that's a concern here. You mentioned the $38 billion that they're looking for, and this is going to help build those data centers in Texas and Wisconsin through Vantage Data Centers. This is a real concern, because Morgan Stanley came out with a note. They released a report warning that Oracle's credit risk could worsen. The 5-year credit default swaps climbed up to 1.25 percentage points this month. And those protection costs could push past 1.5 percentage points soon. So Morgan Stanley kind of raising the red flag here on Oracle. You mentioned the pain that it's been under. It's down 40% from all-time highs that we saw in September. I mean, this stock was above 345 points, and that was on the back of that OpenAI deal, $300 billion investment that OpenAI is going to make. It's funny, Marley, because everybody that was talking about OpenAI over the last 6 months until maybe the last 30 days, anybody that had a partnership or deal with OpenAI was considered, at the forefront of, this chat GPT, this AI revolution. But now you're starting to sit there and go, well, is OpenAI, in all their obligations that they have, are they going to be able to actually come through on a lot of these deals? And that's a concern. In Oracle, you're seeing it because they've got so much of their RPO, the remaining performance obligations, tied into that OpenAI deal, and that's a concern for investors at this point.
It certainly remains to be seen. But Tom, we appreciate you being with us to talk through that big story and also the CME halting trading. We did just get an update, though. We're about 10 hours into this outage. The CME Group saying they are hoping to have futures trading back online by 7:30 Central, so in about 21 minutes here. But of course, we'll keep updating you as the show goes on. But thanks again to Tom White.